So when you look at the future prospects of a bank, you might say, okay, now that the environment has changed, being higher interest rates, the earning potential that we're expecting, the rate of return that we're expecting to get off that asset as investors has decreased. So therefore the share price and the value of that asset has gone down. So it's really as simple as thinking about it on a really small scale, something that you sort of know and understand, and then expand that out to...
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are, favorite time of the week, 360 Money Matters podcast.
Andrew. I'm going to love talking about this one because
It's a good topic.
it's a great topic. And you know what?
Even so, the person that organised it.
This is true. This is true. But you know what? I mean, look, financial advisors deliver so much value to clients, but this is probably the thing that
Moves the needle the most.
has the largest impact.
Yep.
Yeah, I mean, that's a big statement. I reckon it's probably right. Andrew, what are we talking to everybody about today?
Yeah. Today we're talking about the most common questions that we get in a market decline.
Yep.
And now it's kind of a weird thing to say that a financial advisor, you know, the biggest value that maybe I see and we see in it is, you know, the discussions that happen ad hoc. And the thing that I like to tell clients is the most value that you get out of me is not, you know, yes, we're going to put you in the right structure. Yes, we're going to work towards achieving your financial goals. Yes, we're going to put together a plan. But most of the time, it's not the perfect plan that makes success or failure.
Mm-hmm.
It's the one big mistake that you're going to avoid. It's the one bad decision that you're going to make that's going to derail everything. And you know, I'm going to do a Billy here and start talking about, you know, running a marathon and, you know, fitness and gym. And
You're the marathon runner.
Yeah, exactly.
Not me.
So the equivalent that I say is, or the equivalent is, let's say that you're going to take, you're running a marathon, right? And it's going to take, whatever, it's going to take 3.5 hours to do. In that 3.5 hours, one decision that you make to stop running, like you need to, for 3.5 hours, say, I'm going to continue, I'm going to continue, I'm going to continue. And 1 second of a decision to say, I'm going to stop, is what completely derails absolutely everything. All the training, all the preparation, the time at on the day, everything, it's all around a 1 second decision. Exactly the same thing with investing. You prepare, you build a plan, you do absolutely everything that's going to take you from where you are to where you want to get to. And quite literally 1 second decision. It's, okay, something's happened in markets and I need to sell everything. And all of a sudden, it completely derailed everything that you've done. Or I need to sell to cash. Or, you know, and we'll run through some of the questions that, you know, we get asked and some thinking behind it. But all it takes is just a small lapse in concentration over an incredibly long time period. And it doesn't matter that you did everything right all the way up until that point. It basically undoes all of that good work.
Yeah, and it's interesting. And I mean, look, we talk about human psychology and fear and what have you, and we'll get into some of the questions. I've actually got an analogy because a lot of the times that we talk...
Is it a gym one?
No, it's not. It's not a gym one. I could probably use a gym one. No. But no, the truth is, a lot of the times we're trying to, as advisors, we're trying to take a complicated financial circumstance and explain it in language and move all of the mumbo jumbo out of the way and what have you in sort of plain English and concepts that people understand. So I tend to think about markets declining, volatility up, down like this, right? So you make a decision. I want to grow my wealth, right? Whatever that looks like. Yeah, I'm going to need more money in the future than I'm going to need today. So I compare it to planting a tree, right? We're going to plant a tree, and in 20 years' time, it's going to be this huge oak tree or a huge fruit tree, and it's going to bear fruit and what have you, right? You nurture it, you put some water, nutrients, so you're contributing to it. You've picked the location, but every time a storm comes or every time something happens, you go, oh, you know what? I'm going to pick up that tree, I'm going to uproot it, and I'm going to replace it with a different tree. Or I'm going to take this tree out and I'm going to go put it over there. That's exactly the same thing as what we're talking about from an investing perspective. Yes, you have to adjust it, you have to water it, you have to put some nutrients, you have to tweak it, you have to tend to it. You might have to prune the branches in bits and pieces, but at some stage a branch will fall off. At some stage the leaves will get singed by, being burnt. The frost might damage it, certain things like that. I think if you use that analogy, it's obviously a lot easier to compare that to a tree versus sort of looking at your money going down. But that's the example that I've been using with people, and I think it definitely resonates. Andrew, what are some of the specific questions that we hear?
I think first and foremost, it's should we get out and just wait until things settle? So, Bills, should we get out and just wait until things settle?
You got a crystal ball?
I don't have one.
No, I don't have one. I don't have one either. But look, the truth is, like what we were saying before, volatility feels uncomfortable.
Yeah.
Stepping out locks in losses. And when you look at some of the data around kind of your re-entry point, because everybody looks at a historical graph and goes, yeah, for sure, I would have gotten in here and I would have gotten out there and I would have perfectly timed this thing. The truth is that doesn't happen. And it doesn't happen by skill. It might happen by luck, if you're lucky. But you look at some of the economic data, and if you miss the top 10 recovery days, I'm going to butcher this, but you've gone and basically blown your recovery.
Yeah.
Right? So rather than trying to pick and time the market, which we talk about all of the time, you're better off just holding course.
Yeah.
Because the markets are going to correct faster and recover faster than your confidence and your conviction as well too. So yes, should we get out and wait until things settle? The answer, 90-something% of the time, is no. Just hold the course. If your circumstances are of a certain position, like you're about to retire and you can't afford the hit or whatever it is because you don't have the time frame, I would suggest that you should have proactively been working with, or the financial advisor that you've been proactively working with, the investment strategy that you've got should take that into account, because investment markets, they're going to be volatile. They're going to do their thing. Sometimes they're going to be up. Other times they're going to be down. You're going to go through a correction. Stuff happens. And the truth is you need to be invested in order to make your money last so you can live, obviously off the income stream and the return that it gives you. So short answer is no. And it's very hard to do yourself, which is the reason why I think this is the most important thing from an advice perspective, that where we probably generate our most amount of value to clients is to talk them off the ledge.
Yeah.
Stay invested, stick with the strategy, turn down the noise, keep doing what you're doing, leave the tree alone, keep pruning it, keep planting, keep nurturing it, keep watering it bits and pieces. But most of the time the answer's no.
Yeah, absolutely. And Bills? I'm just handing it all over to you. I'm the interviewer.
Let me ask you this question because I love this one. Is this time different?
Every single time that there is market volatility, it feels different. There is a different reason for it. We were talking how many, I'd say, a couple of years ago was stagflation. And this is something that the market hasn't seen before since the 70s. And everything feels like it's going to be very, very different. And all of a sudden markets are going to correct and, the entire world is going to change. AI is going to change an economy, and all of a sudden people are no longer going to be employed. And if people aren't going to be employed, then, what's the function of businesses? And there is any number of reasons to feel like a market is different, or to feel like a period of volatility is different to the last. And it always does feel different because life is different and the economy and the world has changed. But what is not unique is the pattern that follows a market correction. Mm-hmm. It's normally when you're seeing a sharp decline, you're seeing a subsequent recovery that's happening pretty sharply and pretty quickly thereafter. And so sometimes taking a long-term view around, okay, what happened in the past?
Yep.
Yes, this situation might be different. The catalyst might be different, but how did things transpire in the past really helps ease your nerves and recognize that, okay, what feels very sharp now in the long term is not all that sharp. And I think that, to throw it out to Vanguard, they do an index chart and they show what's happened in markets over the course of the last 30 years. And one of the things that I like to show clients when they say, is this time any different, is zoom in. Like you zoom in on a market correction. You can do .com bubble, you can do GFC, you can do anything. And you see the chart when you're zoomed in and it's this massive decline and all you're seeing is red and it's incredibly scary. And then you slowly zoom out of the chart and all of a sudden what looked like a massive decline is slowly becoming less and less as you start to look out. And what you're seeing is the general trajectory of the line just moving straight upwards. So is this time different? Very likely the answer is no. And while the circumstances and the catalyst and everything might be different, the pattern around the recovery and what will happen to the market thereafter is very much the same. It's what has happened in history.
So is this time different? The answer is no.
Billy, why is my portfolio down when the news sounds bad?
You think about portfolios and think more so of the underlying investments that sit in them. So let's take a really simple example of a banking stock, right? So let's use a banking stock and let's say that interest rates increase, which they have, and the expectation is that it's going to be harder for people to pay their mortgages. More people are going to default. More people are going to go into business arrears. The banks are going to need to do more in order to support customers. So the future earnings outlook for the bank means that they're probably, in this hypothetical situation, means that they're probably going to earn less money because of those things, right? So when you look at the future prospects of a bank, you might say, okay, now that the environment has changed, being higher interest rates, the earning potential that we're expecting, the rate of return that we're expecting to get off that asset as investors has decreased. So therefore the share price and the value of that asset has gone down. So it's really as simple as thinking about it on a really small scale, something that you sort of know and understand, and then expand that out to, an economy. You can also use food as an example. You go to the grocery store, stuff's getting more expensive, or interest rates have gone up, cost of living's increased, people are spending less money at the supermarket, they're penny pinching, they're doing what have you. Maybe you think, okay, the big supermarket chains aren't going to make as much money in the future as what they are now. Okay, that stock price, the future earnings that we're expecting is going to decrease, it goes down. So when you think about that across an entire portfolio, you're thinking multiple sectors, different businesses, different companies. Predominantly, that's the reason why your portfolio is down, because they're factoring in the impact of the negative news that you're hearing, the impact that it has in prices. And markets react very, very quickly to both negative and positive news as well. So it can work in both ways, but essentially that's probably the simplest example, is just condense that thinking down to something that you know and understand, and then expand that out to an economy, and that's the reason why. And this stuff's trying to preempt, right? This stuff's happening all the time.
Yeah. One of the other questions we tend to always get is, if we made the wrong choices, do we invest in the wrong things? And look, some of the times the answer is going to be yes. Yeah, maybe this wasn't the best asset class to be invested in. Maybe this wasn't the best decision to go down. But most of the time the answer is no. We're making, and if the answer is yes, maybe investing in a particular stock was not necessarily the right stock and the outlook is now different, then okay, you pivot, you adjust, and you move the portfolio in order to make sure that it's still performing in line with future expectations. But the vast majority of the time, the decisions that you're making are right for that point in time. And what is happening in markets is that it's focusing on the short-term volatility. And where you're I think a really good example of this is the announcement of tariffs in the US, and we're talking about tariffs between the US and Europe. It had absolutely no bearing on the Australian market. I mean, yes, in some way, if there is less consumption from the US, then maybe maybe Europe isn't going to buy as much from Australia, and maybe the impact on those economies is going to have some flow down effects, but it did not justify a sharp decline in the Australian stock market or the level of what we saw. So a lot of the times it's not that you're making the wrong investment decisions. The market is focusing on the short-term volatility and the short-term impact. And then next, 5-10 years time, likely there's absolutely nothing to worry about. So volatility reflects sentiment a lot of the time. And your planning shouldn't be focused on the short-term sentiment and the short-term shocks. Your plan and your financial plan should be focused on, okay, where do we want to get to long-term? And perhaps it's actually something that you can take advantage of and actually buy into markets at that point in time if you do have the capacity to do so, and with some foresight around your planning.
Yeah. And just because I love my analogies, I tend to think about that in terms of making the wrong investment choice. It's basically like saying, we're going on an airplane trip. We're going to experience volatility, turbulence, right? You can't fly and then get to your destination and go, did we take the wrong flight? Did we take the wrong route? Did we do this? Did we do that? Because we experienced turbulence. That's part of flying.
Yeah,
exactly the same thing. The one that I love, why didn't we see this coming? That's the one that I love. Like I said, crystal ball stuff. Volatility is extremely unpredictable. Back to what I was talking about, planning isn't about trying to preempt these things that are going to happen. It's about having a robust plan in place for when they do happen. How do you navigate through it? Because you can't predict this stuff. And especially with, I guess, the pace of change that's happening in the world these days, it's going faster and faster and faster. It's impossible to see things coming for most part. I mean, you think back to a recent example about COVID. I mean, that moved extremely quickly and caught everybody by surprise. But that's a perfect example of something like that. But it's just volatility is unpredictable by nature, and it's not about forecasting that. It's about being prepared that when it does hit, how do you go through it?
Yeah. And I think that's really the main sentiment that we want to drive home in this episode, that a lot of the discussions that we're having is actually going back to the original discussion. It's going back to what was the original purpose for this. And sometimes the discussion is not necessarily a financial one, or sometimes it is. And what I sometimes like to do with clients is say, okay, this is where we're at. So what happens and what are the implications if we do move everything to cash? If we move everything to cash and our rate of return is our cash rate of return, are we going to meet our retirement objectives? Are we going to be able to, fund private school fees, go on a holiday every year, do all of that stuff? And the answer is, for a lot of the times, no, because you're not generating enough of your rate of return. So it's, okay, well, what choices do we have? The choice that we have is to continue through, follow the strategy, because if history is anything to go by, we're still likely to get there.
Yeah.
Or do we readjust our goals and say, okay, from now on, we never want to take any risk?
Yeah.
And for most people, it's the penny drops and you realize, okay, this is a part of being invested in the game, and I don't need to focus on short. What I need to look is long.
Yep. Andrew, well said. Hopefully we did that one whole heap of justice in terms of the questions that we get. And I guess they're all justified, but it's our job to help people navigate through those. But Andrew, thank you for today.
Thanks, Bills. Always good jumping on the podcast. Thanks to our viewers and our listeners. If you did get value out of that, or you did have any questions, please reach out to Billy and myself. Details are in the show notes. Like, subscribe, and we look forward to catching you on the next podcast.
Thanks.
Thanks for listening today. If you have any questions on what we talked about, or would like to have a chat about your money journey, visit us at 360fs.com.au.
The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of Akumin Financial Planning Pty Ltd.